All right, so most of us think about money in a really simple way, right? You earn a salary, you pay your taxes, end of story. But what if I told you the ultra-wealthy are playing a totally different game? A game with a completely different rulebook. Today, we're going to break down one of their most powerful, and believe it or not, perfectly legal strategies. It's called buy, borrow, die.
And the difference in those rulebooks? It starts right here with this one simple idea. On one side, you've got your salary. The second it hits your account, boom, it's taxed. We're talking 30, maybe even 40% gone. But on the other side, you have things like stocks or real estate, what we call appreciating assets. And the wild part is, their growth isn't taxed at all, not until you actually sell them. This one distinction, this is the secret key that unlocks this entire strategy.
And that fundamental difference leads us right into what's known as the earned income trap. It's kind of a tough pill to swallow, but here it is. From a pure tax point of view, your salary is literally the most expensive way there is to fund your life. I mean, think about it. Before you even get a chance to decide how to spend your paycheck, a huge chunk is already gone. You've got federal and state taxes, Social Security, Medicare, it all adds up. You're basically working the first few months of the year just to pay the government. This is the game that most of us are forced to play.
So what if you could play a different game? You know, as this quote says, it's not that billionaires are necessarily smarter than everyone else. They're just operating within a completely different financial framework, one that lets them sidestep that earned income trap altogether.
So, what does this different game actually look like? Well, it's a two-part cycle called the buy and borrow loop. This is the engine of the whole strategy. It's how the wealthy get access to their fortunes without ever having to sell their assets and trigger a tax bill.
And honestly, it's deceptively simple. Step 1, you buy assets that you expect to grow in value over the long haul. You know, things like stocks, real estate, stuff that compounds over time. Then, step 2, instead of selling those assets when you need cash, you borrow against them. And here's the magic trick. A loan isn't considered income, so it's not taxed.
Now, the buy phase. This requires a complete shift in your mindset. The goal isn't to buy low and sell high, like we always hear. No, the goal is to buy and hold, basically forever.
This all works because of a concept called unrealized gains. So imagine you buy a stock for $100, and over time it grows to $1,000. You're $900 richer, right? Well, not in the eyes of the IRS. As long as you don't sell that stock, that $900 gain is unrealized and it's completely invisible to the tax man.
I love this analogy. Think of it this way. You're not a lumberjack looking for trees to chop down and sell for a quick buck. You're more like a park ranger, carefully cultivating a forest that gets bigger and denser and more valuable every single year. Okay, but that raises the most obvious question, right? If you never cut down any trees, how do you build a house or buy groceries? I mean, how do you actually live? Simple. You borrow against the value of your forest. Your massive portfolio of assets becomes the collateral for low-interest loans. It's like having a tax-free ATM. You get the cash you need to live on without ever having to sell the assets that are making you wealthy. Let's just look at the numbers. Let's say you have $1 million portfolio and you need $100,000. If you sell off stock, you're going to lose maybe $20,000 of that right away to capital gains tax. You walk away with $80K. But if you borrow that $100K, you get the full amount, you pay zero tax, and, this is huge, your entire $1 million portfolio keeps on growing. It's kind of a no-brainer.
But wait, you're probably thinking, what about all that debt you're racking up? This is where the final, and frankly, most powerful piece of the puzzle comes in, the die phase. It sounds a little morbid, I know, but it's the absolute key to making this whole strategy work across generations.
It all hinges on a feature of the tax code called the stepped-up basis. So here's how it works. When you pass away, your heirs inherit your assets at their current market value. Let's go back to that stock you bought for $10. If it's worth $1,000 when you die, your heirs' cost for that stock is legally reset to $1,000. All that growth that happened during your lifetime, poof, it's legally wiped away for tax purposes.
So, the bottom line is, the tax bill on a lifetime of compounded asset growth gets reset to zero. All of that wealth passes to the next generation completely untouched by capital gains tax. And look, this isn't some shady loophole. It's a feature of the tax code. It was designed to prevent heirs from getting hammered with two big taxes at once, estate tax and capital gains.
So here's how they finally clear that debt. First, the heirs inherit the portfolio. Second, that tax basis gets stepped up, resetting the clock. And third, they can then sell off a small, now tax-free portion of the inheritance to pay back all those loans. The debt is gone, the tax is avoided, and the family wealth stays intact to start the whole cycle over again.
Okay, now this whole thing might sound like it's only for billionaires, but the underlying principles, they can actually be applied at smaller scales. But, and this is really important, you have to understand that this is not some risk-free magic trick.
For most of us, the first big goal is just building up a portfolio that has some real weight to it. The late great Charlie Munger once said that the first $100,000 is a bitch. But once you get there, that's when the power of compounding really starts to do the heavy lifting for you. And that's when a strategy like this can become a real possibility.
But you absolutely have to be aware of the dangers. A big market crash could crush the value of your collateral and trigger what's called a margin call, which means the bank can force you to sell your assets at the absolute worst possible time to cover your loans. And if interest rates spike higher than your assets are growing, the whole thing can completely backfire. You cannot over-leverage yourself.
Ultimately, understanding this strategy is about a really deep, fundamental shift in how you think about money. It's about moving away from that get-rich-quick mindset of trading and selling and moving toward the discipline of own assets forever. So it leaves us with a pretty important question to ask ourselves. Are you working for your money, or are your assets working for you? Are you still caught in that earned income trap, or are you starting to build a foundation for long-term wealth? The choice of which game you want to play, that's up to you.